Today, I'm going to give you an intuitive introduction to the call-put parity equation. First, we'll understand its usefulness in the world of financial markets. Then I'll illustrate two of its properties with concrete examples. As a reminder, a call option gives the buyer the right, not the obligation, to buy an underlying asset at a certain price, the strike price, and on a certain date, the maturity date. A put option gives the buyer the right to sell the underlying asset. The parity equation links four major financial assets: vanilla call and put options, an option stock, and a fixed income asset. The call-put parity equation states that the purchase of a call option combined with the sale of a put option of same strike price and maturity is equivalent to buying the underlying asset of the option while going short of a zero-coupon bond whose nominal value is the strike price of options. Now, let's take a look at this equivalence graphically. Considering that we're at maturity, we know that call and put prices are equal to the payoff. Let's represent the put option and the call option by their respective payoff. First, as stated earlier, we go long of a call option. In the same time, we go short of a put option. By adding the two curves point by point, we obtain the red curve shown. This straight line, with slope 1, represents the stock exactly, except that it is shifted by K dollars. The profile is exactly the same. For simplicity of visualization, let's place K on the other side of the equation. We see that the linear combination of assets on the left-hand side of the equation exactly replicates the underlying stock. Thus, by an argument of no arbitrage opportunity, we obtain that for any time to maturity, call-put parity is respected. To demonstrate the theory, simply consider the two portfolios on either side of the equation. By discounting their value at maturity, we find that the two quantities are equal. But now, you may wonder, how to use the call-put parity in practice? Let's consider the following scenario. Imagine you're a trader and you want to place an order for a call option. However, there are no call options on the market for the stock you want. The only instruments available are the stock, put options on that stock, and a zero-coupon bond. Considering this market, how being exposed to a call option? The answer lies in the fact that call-put parity is what we call a replication equation. This means that we can replicate the elements of the equation by a combination of the others. In our case, we want to buy a call option. To do this, all we have to do is modify the relationship a little, and we have the expression for the call option as a function of the instruments present in the market. To replicate the call option, we need to buy an underlying asset, going short of the zero-coupon bond, and buy a put option. If you want to replicate a put option, all you have to do is isolate it in the equation and express it as a combination of the other instruments. The same goes for stocks and fixed income. One of the great advantages of put-call parity is that it is highly visual and intuitive. Once you know the form of the payoff of each instrument and that the fixed income component is simply a translation on the y-axis from the origin, all the replication equations are instinctively found. That's why, in my opinion, it's essential to understand this equation. Beyond its simplicity, you need to see the real consequences for the market. And even if, by understanding this replication, we think we've understood everything about the equation, in reality, it's still hiding a few secrets. And one of the secrets actually lies in this equal symbol, linking the two parts of the equation. Call-put parity is based on the hypothesis that there is no arbitrage opportunity. This hypothesis asserts that it is impossible in the financial markets to find a strategy that will produce a positive gain with certainty throughout the strategy. Under no arbitrage opportunity, the left-hand side of the equation must be worth exactly the same as the right-hand side, because in terms of payoff for the buyer, it amounts to exactly the same thing. A price difference between the two sides of the equation would make no sense, because two identical products at maturity would have different prices. It is thanks to this hypothesis that this relationship is an equality and not an inequality. Imagine that we have an inequality. Then, in this case, the following portfolio always yields a positive return, so we have just found an arbitrage, and therefore guaranteed money. However, as I said, the absence of arbitrage opportunities is only a hypothesis. It may happen in certain cases that are more or less persistent over time that the market offers arbitrage. For example, if assets are illiquid, which means that there are few transactions in these products, different brokers may not offer the same price for identical products. But let's get back to our relationship. Let's take a concrete example to understand how this equation applies to the financial markets. You are a multi-asset trader observing the following prices. Alphabet shares are worth 130 US dollars. The put option with a maturity of 1 week and a strike price of 135 USD is trading at $3, and the call option with the same characteristics is trading at $8. For the risk-free rate, we use a US Treasury bond, which represents the instrument linked to the risk-free rate. Because in general, the risk-free market rate can be considered equal to the yield on a US Treasury bond. This Treasury bond, which will be worth $130 in 1 week's time, is currently trading at $127. The first part of the equation is therefore worth 8 minus $3, and the second part is worth 130 minus $127. We therefore have a violation of call-put parity. These two portfolios both create the same payoff but have different prices. The trader will therefore buy the undervalued portfolio and sell the overvalued portfolio. For each contract sold, he will withdraw the difference. Now you know. If you ever manage to observe an opportunity like this in the market, then you have just found an arbitrage. But I hope for your sake that you are quick to execute orders, because since the arrival of algorithms in the market, finding this type of mispricing is extremely complicated. Entire teams of researchers in hedge funds and investment banks are working on optimizing trading algorithms in order to execute orders as fast as possible and get all the profit available from this mispricing.